as the government shutdown kind of persists, and as Ben was just kind of indicating there, it feels like tensions are actually only going to kind of worse here. What that really does mean for our central bankers, for the Fed, how that complicates things for them. If they don't have the hard data they need, Michael, they're not getting the government jobs data, they're not getting the inflation data, what does it mean for them? What does it mean for this next meeting?
Sure, yeah, good to be here. So there's a lot to talk about here. This shutdown comes at a critical juncture for the Fed. As we were talking about earlier, you're seeing a slowdown in the labor market on the one hand, and on the other hand, you're worried about the continued rise in prices due to tariffs. So as you continue to monitor that, we're missing out on data that really will start to dictate which way the Fed starts to lean. Now, prior to the shutdown, it was really looking like the labor market was slowing down. And so what the Fed would want to see was signs from other labor market data that is set to be released that maybe that was stabilizing. Now, you have alternative data sets, and we can talk more about those. But even with those in hand, I think the Fed really has to be cautious. The other mandate in terms of prices, you don't really have a good alternative data set there. So I think the conundrum for the Fed will be, do you rely on the known labor market data with some of those alternative data sets, or do you kind of wait to see and take a pause here until the data is released?
So if this government shutdown persists, Michael, and the Fed doesn't have that data, what are the odds to you that they hold because of that? Because they just don't have line of sight. Is that increasing?
We think they will pause at some point, whether it's due to the release of the delayed release of data now, or due to some of the data we get later on. And what I mean by that is, it's not just the data that we're going to get in October. There are ripple effects to these delays. So if you think about the CPI, the data that is collected for October is not being done right now. So those workers are at home. That increases the odds that you're going to have data imputations. That'll be released in November, and it calls into question the quality of that report. Mm-hmm. And then relative to that, in December, you're going to get the November report. And relative to the imputed data, the Fed may have questions around the directionality of some of the price changes. So you're really going to have 2 or 3 months where the data quality is going to be called into question.
Brandon, I want to bring you in here as well. Now, you're looking through this through a different lens, Brandon. Walk me through how you're thinking about the government shutdown.
Sure. Yeah. Thanks for having me. Certainly, we're on day 8, as you've probably seen some countdowns on various news programs, and that's about the average number of days we've seen in a shutdown going back to the mid-70s. Your other guest is absolutely right in terms of data integrity. Leading into this, if you just take CPI, for example, historically, you've seen about 10% of the basket of CPI goods that are estimated by staff. The last couple of months, you've seen that tick up to about 1/3 of the CPI underpinnings within that data calculation. So you're getting murkier and murkier data. There are a lot of alternative data sets. It's not the 1980s or even the 1990s, so that helps from a mosaic approach. But still, there's a little bit of inference that needs to be had here. The Fed and then also market participants. We are seeing about a quarterly GDP drag estimate of about 10 bips per week as long as this drags on. And by the way, that's about $400 million per day in compensation that federal workers are not getting to put in their pockets and then spend into the economy.
So Brandon, what about this topic? I was just talking about there with Michael. Let's say the Fed decides, you know what, the government shutdown is persisting. We are not getting the hard data we need. We don't have the line of sight we need. We're going to hold here later this month, this next meeting. I'm curious if that was the case, how do you think markets would respond and react to that?
They wouldn't respond well, because if you look at the meeting minutes that just came out this week, the underlying tone was that there was going to be this continued kind of glide path of continued rate cuts. I think the question that was raised there that a lot of people have already prognosticated on is how many cuts we get from here. So the next cut that we're seeing is more than likely a go. However, if there was too murky for the Fed to make a decision and pause, that would certainly throw markets into a tailspin, because as you know, they've been pricing in these cuts well in advance of the cuts actually being received. So that'd be a big detour and inflection point with this market trajectory.
Michael, we don't have the government data, but as you were mentioning, you have these alternative data sets. When you look to those data sets just as an economist, do they completely fill in the gaps here, or do you feel like you don't have full line of vision?
Unfortunately, we don't have the full line of vision. And what I mean by that is sometimes you can get the direction right, but you're really missing out on the magnitude. even with some of the better alternative data sets that are out there, for example, for the payroll report, there are pretty wide ranges of estimates. I've seen anything as high as 60,000 for the September estimate and as low as negative 30,000. So that's a pretty wide range. You also don't have a good sense of what that means for the unemployment rate. And going back to the Fed and what it means for them, they focused on that as a better measure of labor market health right now because the break-even rate of payroll gains is really shifted in the past couple months due to changes in immigration policy, as well as the uptick in retirements that we've seen. So that's a really important way to interpret the payroll data. That is to say, it is changing, but the unemployment rate is really a better gauge of labor market health, and that's just something we're not going to get.
So Brandon, as this government shutdown persists, the questions we all have about possible impacts and ripple effects, economy, labor market, Fed, rates, has it caused you, Brandon, to reconsider in any way how and where you want to put money to work?
Not dramatically, because we are, like I said, in day 8, so that's certainly something that you have to take into account, but thus far hasn't caused any major shifts in some of the underpinnings. Earnings remain strong. We still have kind of this U.S. exceptionalism that remains. Obviously, mega cap, big tech, those continue to propel markets forward. You're starting to see an emerging trade in small caps. So over the last several days, that hasn't necessarily changed things. It does make you stop and pause, though, and say, in the absence of this data, how can the market continue to propel forward, especially as this drags on further? But what that doesn't change, though, is underlying earnings, which have been dramatically increasing. In fact, there's only been 5 times since 2003 that growth estimates have been revised higher into an earnings season like we're about to have. Q3 has ticked up from 8 to 8.8%. So really some underlying strength there in markets.